Now, this is week 3 of the Mac Notes Introduction to Financial Accounting, and we're going to look at how we adjust our records prior to preparing financial statements. To begin with, we must understand the difference between cash-based accounting and what is called accrual basis of accounting. And that is the reason why we have to adjust our records. And we're going to then look at the different types of adjusting entries that have to be made. We're going to learn how to prepare those entries, post them to the ledger, and prepare an adjusted trial balance. To begin with, the cash basis of accounting recognizes revenues when cash is received and recognizes expenses when cash is paid out. Now, the accrual basis of accounting recognizes revenues when sales are made or services are performed, regardless of whether we receive cash or not. Expenses are recognized as they are incurred, not when they are paid. And that's the type of accounting we're going to do. For instance, assume a company performs a service for a customer on account, which means the customer will pay later. Although the company has received no cash, the revenue is recorded at the time the company performs the service. Accountants use the accrual basis of accounting, which matches expenses incurred against the revenues earned. Why? Well, let's take an example. Suppose that this company called Fresh Colors paints a large building in 2011. In 2011, it incurs a lot of expenses and pays those expenses, salaries and painting costs of $50,000. When the job is done, it bills the customer $80,000, but does not receive the cash until 2012. Now, if we were on a cash basis, in a 2011 financial statement, we would show no revenue because we only record revenue when we receive the cash. And we would show $50,000 in expenses. So we would have a loss of $50,000 in 2011. And in 2012, we would only show revenue coming in of $80,000, no expenses, and we'd have a huge gain in 2012. So you can see the financial statements are not matching expenses against revenues. For the accrual basis, we would recognize revenue when we earned it, and we earned it in 2011. And we recognize expenses when we incurred them, not when we paid them. But in this case, we incurred them and paid them in 2011. So our net income in 2011 is $30,000. In 2012, nothing happens. So you can see why accounting has to be on the accrual basis, because that is the only way we can match revenue against the expenses incurred to earn that revenue. Now, in order for a company to prepare financial statements, it has to have a cutoff time. An accountant has to divide the business entity's life into time periods. These time periods are usually a year in length, could be a quarter or a month, and they're called accounting periods. Now, we refer to the accounting year as the fiscal year. That is one accounting period of 1 year. Compare the fiscal year to a calendar year, which is 12 months ending December 31st. The fiscal year is 12 months, any consecutive 12 months during the year. Could be any time. Now, adjusting entries are journal entries that we make at the end of the accounting period in order to properly match revenues against expenses. This is referred to as the matching principle and is one of the underlying principles in accounting. Now, there are only 6 or 7 types of adjusting entries, and we group them together. There are the adjusting entries that fall into the deferred item category, which involves data previously recorded in the accounts. These entries then have to be adjusted at the end of the year. And the other type of adjusting entries are accrued items, which consists of adjusting entries relating to activity on which no data has previously been recorded. Recall, accrued means has been accumulating and has not been recorded. And so therefore our job is to record it. at the end of the accounting period. Now, you learned before how to journalize transactions. Transactions resulted from source documents. We had proof that this took place. There was a sales invoice or a purchase order. That was the transaction, the source document. Now, these transactions that we're talking about are sort of invisible. They've happened over time, but we had no occasion to record it at the time it was happening. We wait to the end of the year, and then we record it. We make the adjustment. Now, the adjusting entry, one part is always an income statement account, and the other is a balance sheet, because we're adjusting between the income statements and the balance sheet. Now, for the deferred items, they fall into these categories, and they repeat themselves. There's the prepaid expenses, basically. For example, I prepay insurance for a year. When I prepay insurance, I have the right, I am insured for the year. That is an asset that I will use up over the course of the year. The same with prepaid rent. That is too an asset. It allows me to stay in that building for a particular period of time. But you see, as I go through that period of time, I am using up that asset. And there's supplies on hand. That is, we buy in office supplies or cleaning supplies or what have you. We record that entry, but every time we use the supplies, we don't record an entry. We wait to the end of the accounting period and count up how much has been unused and therefore make an adjusting entry to recognize how much has been used. Then there are the journal entries, adjusting journal entries would recognize depreciation. And finally, there's this weird one called unearned revenue. Unearned revenue Unearned revenue is a result of a customer paying us for a product or service that we have not delivered yet. But by us accepting that money, we are obliged to either provide the service or deliver the product or return that money. So you see, unearned revenue is a liability, and we record it as a liability when we receive the cash. Now, as time goes on, we are earning that revenue, but we haven't recognized that yet. So we have to make an adjusting entry to do that. Now, in the next video, I will go through in detail each one of these adjusting entries. And lastly, there are adjusting entries for accrued items. Accrued assets such as interest and accounts receivable that have not been recorded. So you see, accrued simply means that it's owing or it's been earned, but it hasn't been recorded. So therefore, we have basically accrued revenues because we have earned the revenue, but it's not been recorded because the job hasn't been complete. For example, I started a job December 15th. It's going to be finished January 15th. If my cutoff period is December 31st, then I have only completed half of that job, but that revenue was earned in this year. But I would have no occasion to bill the customer because the job's not finished. Therefore, in my records on the 31st of December, I would have to recognize that I've earned some of that revenue. The same thing with accrued expenses. Those are expenses that are being accumulated, and as we cross over our artificial accounting period timeline, like December 31st, we must make adjustments to recognize some of these accrued expenses. As I said, in the next video then, I will go through in detail each one of these journal entries.